Good afternoon, everybody. Thanks for joining us today for our Winthrop Wealth webinar series. We're excited for today's topic, which is really on educational planning. And I'm pleased to be joined by Kris Adrian, Vice President of the National 529 Specialist at JP Morgan Asset Management. So Kris, thanks for joining us today, and thanks to Pete, our good friend over at JP Morgan, for helping us set this up. We get a lot of questions around this, especially with a lot of the younger families we have who are planning for new children or have younger children, and what is education going to look like in the next decade or 2 decades? And that's why we have our expert Kris with us today. So Kris, I'll let you take it from here. If there are any questions, feel free to pose them in the chat, and we'll save some time towards the end of the presentation to go through and answer and have a little bit of discussion. But thanks again, Kris, for joining us today, and excited to see this presentation. Personally, I know we get a lot of questions about this, so I'm excited about it. So thanks again.
Thank you so much. Thanks for having me on. This is my very favorite topic. And this morning, as I was putting my daughter Kate on the bus, she reminded me, Mom, there's only 6 more days of school left. And I thought, oh my gosh, I'm 1 year closer to college for Kate, my youngest. She's in 4th grade. So for a lot of families, I'm sure this is very top of mind, getting ready to plan for college if you haven't already, or are you on track? So today I'm going to be sharing slides from our College Planning Essentials booklet, and it's a little book that we put out every year, typically in the month of February. We refresh it with all kinds of data about the costs of college, financial aid, and the Fasfa. For those of you that might have high schoolers that are getting closer to college, got a lot of great slides about that. And then lastly, the 529 plan. So for those that haven't heard of a 529, we'll go into the basics of that, and then some more advanced things that you can do with 529s that are pretty exciting. So with that, I'm actually going to turn to my favorite slide in the entire deck. And bear with me 1 second. For some reason, it is not advancing for me. There we go. Hopefully you can see that okay. These are my own 2 529 beneficiaries. This is my son, Joe, on the left. Joe is 14, and he is actually an excellent golfer, but because he's a teenager, he decided this year that he wants to quit golf and he wants to wrestle instead. So he's actually becoming a pretty good wrestler. He's been lifting every morning. Very high hopes for Joe that he might receive a scholarship athletically. And then my little daughter, Kate, who I had mentioned earlier that I put on the bus this morning, she's 10, she's in 4th grade. She's my artsy one. She loves to play Minecraft. And so for Kate, very high hopes that maybe she'll become a coder in the IT industry because she loves to build maps in both Roblox and Minecraft. So probably very much like your children or your grandchildren, very high hopes for my own 2 kids. And the first thing that I wanted to cover is a common question that I often get. Now, Kris, with the extraordinarily high costs of college in the future, is it even worth it to get a degree? And I like this particular slide to help address that. What it really helps showcase is that for younger workers, if we look on the left, younger workers between the ages of 25 and 29 on average earn 33 grand once they receive their high school diploma, but they'll earn 73% more if they have a bachelor's degree, and they'll earn 115% more if they have an advanced degree. And an advanced or professional degree are typically for doctors or lawyers or dentists. So degrees of that nature, they'll earn on average about 115% more during those young working ages between 25 and 29. And then on the right-hand side, we have all workers across the country. So anyone age 18 plus, and very similar circumstances there where with a high school degree, they typically earn about $39,000 each year, but with a diploma or a bachelor's degree, they'll have 86% higher pay. And those with an advanced degree or professional degree, over 273% higher pay. So we believe it definitely does pay to have a degree, and especially if you have a professional degree. So the next thing I wanted to cover is tuition inflation. And it's the first major factor to consider. This page here helps highlight at the very bottom in yellow that tuition inflation is the fastest growing household expense in the country today. This shows data that goes back almost 4 decades. And what you'll notice is that tuition inflation has grown 840% over that time horizon. And just to put that into context, we have other common household expenses listed up above in blue. Medical care, for example, has grown half as fast, 446% over the same time horizon. And other really interesting things like coffee has only grown 108% over the same time horizon. So really important to note that tuition still remains the fastest growing household expense. And if you look in the little box off to the right, it grows about 5.9% on average each year. It's important to note that number because a lot of families that we speak with are saving for college, but they have it earmarked in a checking or a savings account. And unfortunately, as we all know, checking and savings pay next to nothing today. Really important to consider investing for college just to keep up with that 5.9% tuition inflation factor. And that's why this page, future 4-year college costs, looks so daunting. So earlier I had talked about my son Joe, who's 14, and my daughter Kate, who's 10. If I look at the green bar on this page represents 4 years all in at an in-state public school. The blue bar represents 4 years all in at a private school. So for my own 2 children, I'm looking at roughly $300,000 for 4 years of in-state public school and over $600,000 for 4 years of private school. Those numbers are daunting to me. I've been in business for 20 years, but very important for us to consider what our number might be in the future. And perhaps we can't cover 100% of it, that's okay, but we're definitely earmarking a particular goal. And one thing that Winthrop Wealth can do is actually help you determine what is your goal based on these numbers, and then back into that goal by putting in a monthly, quarterly, or annual amount to help get to that goal. So very important to focus on what your number might be in the future. Next, I wanted to cover financial aid. And obviously the last big bars that we looked at, that's the sticker cost of college. And hopefully there's a net cost of college once you factor in financial aid. And what this chart helps highlight on the left is that college costs over the last 10 years have gone up 24%. But unfortunately, total financial aid packages over that same time horizon have gone down 5%. So what that means is families are being expected to pay more out of pocket than ever before. And when we look at that actual reality, we have this slide here. This is the financial aid reality check. At the top is the grant reality in blue. And keep in mind that grants are need-based. So they're typically reserved for families that have adjusted gross income of $60,000 or less. So for those families who are eligible, on average, it's about $5,000 each year, or $4,900 to be exact. And it should cover, if you look in the little tiny circles off to the right, should cover about 9% of an average 4-year public school. But again, those are need-based, and not all families apply for those. But at the bottom, every family can apply for scholarships. So we've highlighted the scholarship reality in green. And keep in mind that scholarships are merit-based, so based on the merit of the student. On average, it's about $7,300 each year that they receive. And again, if we look in the little tiny circles off to the right, sorry if they're tiny on your screen, but it should cover about 12% of an average 4-year public school. So while 12% might be covered by scholarships, how do we help our kids fund the other 88% is the big key takeaway. And my favorite stat on the entire page is in the upper right, where it says few free rides, 0.3%. That's the average of all college students across the country who actually receive a full ride for college, both academically and athletically. So really small probability that our children receive a full ride. And for those of you on the line who might have received a full ride or might have children who received a full ride, definitely give yourself a pat on the back, because that is extraordinary and a very, very small probability. And my husband was so sure that our son Joe was going to get a full ride playing golf. And when we sit around the kitchen table and do what I call kitchen chats with these slides, I would actually point to that stat, 0.3, and we're investing for college just in case. But it would be pretty awesome to get a full ride. So next I wanted to go into the Fasfa. And the Fasfa is the free application for federal student aid. Every family across the country is encouraged to fill out the Fasfa, even if they think their family isn't going to receive financial aid. And the reason for that is because a lot of schools use this same formula to determine what your aid might be at the school level. So really important to fill it out. Also really important to try to fill it out as close to October 1st, the year before your student goes off to school, as you can. And that's because a lot of schools use the first in, first out method, meaning the ones that apply first typically receive the most financial aid than those that apply at the very end. So again, definitely encourage you to fill out the FAFSA. And a lot of families across the country have no idea what the formula is that the federal government is looking at. So we've demystified that by putting the formula here on the page. What the federal government is trying to solve for is your expected family contribution, or your EFC for short. And it isn't necessarily the amount that you're going to be expected to pay out of pocket, but rather the amount the school and the federal government is going to use to determine how much you might be eligible to receive in way of financial aid. So it's really the two major buckets here in the middle of the page, the parent bucket on the left and the student bucket on the right. The parent bucket, though, is the biggest driver of the entire aid formula. And you'll notice it's really the parent's income that's the biggest driver of the aid formula. It's a sliding scale between 22 and 47%. If you're in a lower income tax bracket, you'll be closer to the 22. And if you're in a higher income tax bracket, you'd be closer to the 47%. It is above a protected amount, but the protected amount is usually very small. So again, parents' income is the biggest driver. Very importantly, I also wanted to point out that parent assets are only up to 5.64% of the entire aid formula. And that's important to note because that's everything from your checking and savings accounts to any of your non-taxable investment accounts or a 529 plan if you might choose to invest for college. And I think that's important because we often hear, well, Kris, I hear that if I invest for college, it's actually going to hurt my chances toward financial aid. The reality is if you had it in a checking or a savings account or in a 529 and it's held by you as the parent, it all counts the exact same. And that's 5.64%. So that's some good news there. When we look at the right-hand side, the student bucket, student income is 50% of the formula. But note in the little fine print underneath that, it is protected to just over $7,000 each year. So if your student earns less than $7,000, don't have to count it. And if they earn more than 7, anything above that 7 will be at the 50% rate. And then student assets are 20% of the formula. So if you have any custodial accounts, those are typically called UGMAs or UPMAs, or if you have any CDs in the name of the student at the bank, those will all be 20% of the FAFSA formula. And at the very bottom, you might have noticed there is a 0% bucket, and that's for any grandparents or other family members or other people for that matter who might open a 529 for the benefit of your child. If they do that, the good news is you don't have to count it on the FAFSA. And starting this year, when grandma and grandpa start to take money out of that 529, you don't have to count it 2 years later. You used to have to count it 2 years later, but you won't anymore after this year. So that's some good news that just occurred a couple of years ago with something called Fasfa Simplification. And the other benefit of Fasfa Simplification is that the FAFSA is going to get smaller. It's now over 100 questions long, and within the next 2 years, they're going to shrink that. It will just be over 30 questions. So that's good news for families as well. So that's the FAFSA for those of you that might have students that are getting ready to go off to college, or for those of you that might have been curious about financial aid formula. Next, I wanted to hop to the solution, and that's the 529 Plan Advantage. For those of you that have never heard of a 529, it's really the 3 major benefits listed here at the top of the page. Some great tax advantages. I think of them very much like a Roth IRA, where it's always your after-tax dollars that get invested. It grows tax deferred. And as long as you use the money for one of the qualified expenses listed off to the right-hand side of the page, all of the earnings in the account come out tax-free. So it is the premier way to save for college, where all of those earnings can grow tax-free. The other thing to consider is that some states have what's called a state tax deduction. So depending on where you might live, you might be eligible for a state tax deduction each year that you put money into the 529 plan. The second major benefit is the estate planning benefit. So each calendar year, you can gift up to $16,000 per child, and that's gift tax-free. If you're married, you can double that. So you can gift $32,000 gift tax-free. Within a 529 account, you have the option to do what's called an accelerated gift, where you can multiply those numbers by 5. So for an individual tax filer, you can gift up to $80,000 per child. And if you're married filing jointly, you can gift up to $160,000 per child as one big lump sum. It grows tax deferred. And again, as long as it's used for educational expenses in the future, it all comes out tax-free. So really that power of compounding can happen right away. And the power of a big investment like that is that you'll have more when your child goes off to college. The third major benefit I wanted to speak to is the control and flexibility. So within a 529, there's always one account owner and one beneficiary. And importantly, the account owner always maintains control of the account. And so at no point can the child call in or go online and take money out of the account. We call that the Harley versus Harvard effect, where they can't run off and buy a Harley. Hopefully it's used for Harvard in the future. But importantly, that control factor can be changed. So if you wanted to give up your account ownership to your child or someone else in the future, you could do that. And then the flexibility component is where you can change the beneficiary on the account up to first cousin. So earlier I had talked about my son Joe, and if he has a leftover balance in his 529, I can actually move that to his baby sister Kate, and that is a tax-free event. And I can do that up to their first cousins. So my niece and nephew, if I'm feeling generous, I could actually change the beneficiary to one of them as well. You can also hold them to perpetuity. So some families use these as legacy accounts, where they'll just allow it to continue to grow into the future for future generations, and you can continue to pass it down the family line if there is a leftover balance. So just very quickly, I wanted to cover on the right-hand side of this page what's considered a qualified educational expense, because it did get expanded a couple of years ago. So it's tuition and fees, room and board, books and supplies, special needs services. So if your child might need a special tutor, that's that particular bucket. And then computers and related equipment. So printers, laptops, ink, things of that nature are all within that bucket. And then at the very bottom, some 529 plans, depending on which state you might live in, also now allow for educational loan payments, up to 10 grand per child. So that's special because the 10 grand can only be used one time over the life of the 529 account. Also K through 12 tuition, this is new. If your child may be going to K through 12 private school, you can now use that for up to 10 grand each year towards their tuition costs. And then lastly, apprenticeships. So if your child might become an apprentice and the apprenticeship program is registered with the Department of Labor, you can now use a 529 for that. So definitely some good news because 529s are becoming even more flexible. The other thing I wanted to point out is that they can be used for vocational schools or trade schools. As long as the school is listed on the Fasfa website, there is what's called a school code search. You can go out and check to see if the school is considered accredited, and then it can be used with the 529. So that's a big key takeaway that I wanted to give you. So lastly, I wanted to talk about the good news, and that's the benefits of compounding. And definitely I wanted to encourage those of you that may not have started to invest yet to get started as early as you can, because the benefits of compounding are definitely on your side if you have time on your side. So what this chart helps illustrate is that if you start at birth, when the child is a newborn, that's the far left, and if you invest $100 per month, that's the blue bar. If you invest $250 per month, that's the green bar. And if you invest as much as $500 each month, that's the purple bar. And so what this chart helps illustrate is that if you do start early, those small contributions can really add up. So with $500, for example, over 18 years, these charts assume a 6% rate of return. But if that's the case, then that newborn will have almost $191,000 when they go off to college. Kind of a magic number because that will pay nearly 100% of 4 years of in-state public school in the future. And if you wait until that same child is 6 years old, you'll actually have almost $90,000 less because that power of compounding was not on your side. And if you start at age 12, that's the far right-hand side, it just helps illustrate that smaller amount that you would have once the child goes off to college at year 18. So for those of you that might be thinking of getting started, definitely encourage you to do that as early as you can and as often as you can, because that power of compounding really does add up. So I think that I had one more chart that I wanted to cover. I'm going to skip forward a little bit. Here we go. So one thing that I wanted to encourage families is that we have a lot of college planning websites listed here on this page. But in the upper right, if you look in the purple section for grants and scholarships, goingmerry.com, for example, is the first one listed in that section. Very popular this year for high schoolers. And if you go online, your student can create an online profile for themselves, and they can apply for grants and scholarships online. One thing about the Going Merry website in particular is that we'll actually find matching grants and scholarships depending on the profile of your student. And they've made it even easier than ever before, where everything is digitized. I remember when I was a high school senior, my mom would make me handwrite all of my scholarship essays by hand on Sunday nights, and I really didn't like having to do that. Now they've made it easier than ever before, and you can actually cut and paste. So I definitely encourage families to keep a Word document of essays that their student has created, and then they can cut and paste similar application essays into their application. So there's a lot of grants and scholarships that go unused each year, and it's a great way to help offset those really big costs of college. Definitely encourage families, even if they just sit down with their student once a week, that it's well worth it. So with that, I'm actually going to turn it back for any questions that there might be from your clients today. And thanks so much for covering these slides with me. I know that we covered a lot. We covered the costs of college, we covered financial aid and the Fasfa, and lastly, we covered 529 plans. So if there are any questions there out there, I'd love to help cover those now.
Kris, that was a great overview, a lot of helpful information there, some things that I didn't even know, so it's always great to get a refresher. I guess one question here that I think we get a lot of is, when should we use a Coverdale versus a 529?
Yeah, great question. So a Coverdale, they were formerly called education savings accounts, and they were created before 529 plans. They are a little bit more limited in their use, meaning that you can only put in up to $2,000 per beneficiary each year. 529 plans are more flexible because you can put in up to $16,000 per child, or if you're married, you can gift up to $32,000 each year, or do the accelerated gift. With Coverdales, you can actually use them for K through 12 educational expenses as well. So that is one commonality between the two of them, because 529s can now be used for K through 12. But with Coverdales, one thing you can also do is roll them into a 529 plan. So if you like the flexibility of 529s and how they can be used for more extensive things, but they can also have higher limits and how much you can put in. One thing you might want to consider, and you could definitely speak with Winthrop Wealth about that, but rolling the Coverdale into the 529 might be something to consider. So hopefully that helps.
That's excellent. Thank you. I didn't know you could roll them into each other, so always learning here. as far as trade schools go, I know that's kind of a hot topic because what does the future of college education look like for people who are having newborns now? A vocational trade school, are there any limitations? I know you said that there's a website where you can go and actually check. So that's news to me that there's actually did they have to have some type of registration with the state or the federal government?
They do, yeah. So let me jump back to that page here. So I'm sorry, my slides are kind of bouncing around. There we go. So there's actually a link here at the very bottom of this page. It might be small on your screen, but it's on the studentaid.gov website, and it's called the Fasfa School Code Search. And on there, they actually have anything that is eligible for FAFSA financial aid. As long as it's listed on that website, it can be used with a 529 plan. They also have vocational and trade schools on there. So I definitely encourage families to do that. And when this link comes out as a hyperlink, I'll definitely send this to you so that you can forward this on to your clients. But when they click that link, they can check to see whether or not the school is considered accredited.
Excellent, thank you. No, that's helpful, and we'll circulate that with the follow-up materials for everyone who joined us today. Here's another good question. So we get this quite often from a lot of our clients who, if they're funding a 529, a couple things. One, overfunding a 529, right? So if you were to fully fund a 529, and let's say that you had $500,000 in there, and your child gets a full ride to university, and you have no other beneficiaries, no first cousins. What is the downside to overfunding a 529, and is there one, or what happens if you really don't have anywhere to use it?
Great question. So there's a few things there. One, if your child does receive a scholarship or grant, you can actually pull that money out of the 529, and that's penalty free. So it waives the 10% penalty that's usually assessed at the federal level if you pull money out for a non-qualified reason. It doesn't waive the earnings or taxes on the earnings at the federal and the state level. So whatever earnings might be associated with that scholarship withdrawal, you still have to pay taxes on those. But the good news is you can pull out an equivalent amount of the scholarship penalty free. The other thing you could consider is some families want to go back to school for themselves. So we've had families that have wanted to go back for an advanced degree, perhaps their MBA. One grandma called in a couple weeks ago. She wanted to go back to culinary school for herself, which I thought was great. So she named herself as the beneficiary and then pulled the money out for herself. That's definitely allowable. The other thing to consider is just allowing it for future generations. So for your own child, even though they received a full ride, which would be amazing, you could use it for their future kids, your future grandchildren, if you'd want to. And then lastly, kind of last resort, you can pull it out for a non-qualified reason or some other expense. And if you do that, there is, again, the 10% penalty at the federal level. And there's also taxes at the federal and the state level, but just on the earnings component. So your principal is always after tax dollars that you put in. Just those earnings are going to be taxed and then have the 10% penalty as well. So a few different options there, but I love that question.
And so the grantor of the 529 can name themselves as a beneficiary.
Exactly. Yep.
So if I want to go to driving school and get my racing license, I can use that 529 to fund that hobby, if you will.
Exactly. As long as that racing school is considered accredited, of course, and on the FAFSA school code search.
Great. Does a 529 can you use a 529 to pay for off-campus housing?
You can. Yeah, so as long as your student is enrolled as at least half time, that's the key factor. As long as a student is enrolled at least half time, you can use it for off-campus room and board. And the way to assess that is to look to see what the stated room and board is on the university's website. You can take out that equivalent amount for room and board off campus. So that's the important factor. You'd want to print out that stated room and board on the college's website and just tuck that into your records, just in case you were to ever be audited and they would ask, why did you pull out $5,800 or whatever the amount might be? You can show them, hey, it was the stated room and board and my student was off campus. So definitely allowable.
That's great. You mentioned being audited.
Yeah.
What is the frequency that there's an audit of the use of 529 proceeds?
It's usually pretty small. The auditors typically want to flag things that are big numbers. So we have had people that have pulled, excuse me, the entire balance out for a car, for example. And usually when you take out a significant amount of money and you don't have anything to prove for that, maybe your child isn't even in college yet, that's typically where you're going to be audited. Or if you might have some other things on your tax filing that might have been unusual, that's typically when they will audit the 529 withdrawals as well. The other thing that is audited is at the state level. If you take a state tax deduction, but you didn't buy the appropriate 529 plan to receive that deduction, and usually that's when you live within a state where you can only take a state tax deduction if you invest in that state's 529 plan. Some families don't know that, so they'll buy another state's plan, try to take their own in-state deduction, and that typically gets flagged as well. So hopefully that helps, and hopefully nobody gets audited. Knock on wood.
Yeah, knock on wood.
Yeah.
Here's an interesting question. So if you have a child and you take them off as a dependent, how long does it take before they can apply for financial aid on their own?
Great question. So it depends. Most schools usually have a 2-year look back for dependency. And so on the FAFSA, let me jump back up there. We had talked about the, oops, no, I went back to my kids, sorry. I went too far. This slide here, so this looks a little bit different. This is if they are a dependent and you've got a parent and a student. The formula looks a little bit different when it's just the student applying. There are some formulas that are listed out on the federal aid website that would help, and it will also tell you how many years your student needs to be a dependent to actually be eligible to file the FAFSA for themselves. But in general, for schools, it's usually 2 years that they want to see that dependency.
Okay, great, thank you.
Yeah.
Another question here, as far as 529 plans, how could a 529 plan impact a student's potential award from a school? Is a 529 distribution considered income to the student in the year of distribution? If so, if a parent has a 529 plan balance for a student to partially cover college costs, is it more advantageous to use for later college years to reduce the impact of any current awards?
Great question. So I'm going to cover the question about if you take money out of mom and dad's 529, does it count as student income? And that answer is no. So the good news is when a parent owns the 529, it's only up to 5.64% of the formula. They won't double count it, meaning they won't make it student's income at the 50% level. So that's the good news. And when it comes to the school and how they look at aid, they're definitely going to factor in if you have a 529 to determine your aid package, and it is going to be at that 5.64% level. So one thing you could consider is pulling the money out of the 529 the first year that they go off to college and reducing that 5.64% bucket. Or the other thing to consider is that if you have liquidity, that's also 5.64%. So if you have checking or savings, so what I'm trying to say is it all counts the exact same. And sometimes it's better to let the 529 plan continue to grow and have that growth potential. Use that in future years for the student, and use your liquidity first, if possible, so that 5.64%, in other words, it all counts the same. That's what I'm trying to say. Hopefully that helps.
Yeah, no, that's extremely helpful. Thank you. How about if the child or the student is a beneficiary of a trust? How does that impact?
Great question. So the way that FAFSA looks at assets, it definitely looks at trusts when the benefactor is the student, and it's going to be counted as the student's asset at 20%. So even if held in the name of a trust, if the student is the benefactor, 20% is how Fasfa looks at that.
Okay, that's really good to know, because I know, especially for some of our clients who are beneficiaries of trusts, that does factor into the formula here.
Yeah.
Right.
We actually have another slide. I haven't built it into this deck, but one of the slides in the College Planning Essentials looks at everything that Fasfa looks at in their formula beyond these elements, these major elements. And then if some students want to go off to private school, they're actually going to be filling out what's called a CSS profile. It's a little bit different than this formula. It's this formula plus a bunch of other family balance sheet items, because private schools get a little bit more involved in your balance sheet if you do go off to a private school. So I definitely wanted to point out that FAFSA is for in-state public schools or out-of-state public schools, and the CSS profile is what gets filled out if they go off to private school. So we do have those two compared in the back of the deck, and that's something I can forward over to Winthrop so that you guys can see the whole thing if you want.
Yeah, that'd be excellent. Appreciate that. Thank you, Kris.
Yeah.
Last question. How long can funds in a 529 that are not used by your children be carried forward? So how many generations can you go? Does it go indefinitely, or is there a time limit on it?
It does. It's indefinite. You can have it grow to perpetuity and have it pass to future generations well into the future, unless there might be a federal change, of course, where they might make a ruling change. But for now, they can grow to perpetuity and continue to pass to future generations. The only thing to consider is that when you're going down a generation, you have to be cautious about generational skip tax, and Winthrop Wealth could definitely help you with that. But basically, as long as it's following the same family line with the original beneficiary and the same generational line, it's a non-taxable event. When you go down a generation, you want to be careful that it's not going to kick in that GST or generational skip tax. So that's the one thing I wanted to make mention of. And as long as you stay under the accelerated gift limits of $160,000 this year, it's a non-taxable event as well.
Perfect. No, that's very helpful. I found this presentation to be extremely valuable and something that we can integrate into some of the conversations we're having with our clients about educational funding. I know we talk a lot about it. Every family is a little bit different in their goals and what they see as far as funding for education, or the willingness to help pay for children's education. So there's a lot of options out there, and that's why the planning is so important. Making sure that the roadmap to get you from where you are today to that end result looks different. It's not one size fits all. So that's where the planning comes in, and that's what we're here to help with. So Kris, I really appreciate you taking the time out of your busy day to speak with us today.
My pleasure.
Everyone on the call, we'll be following up with some resources that will help just to summarize some of the things that Kris mentioned today. And we're always here to have these discussions with our clients and anyone that is interested in learning more about funding education and financial planning. So I'll leave it there for today. But thanks again, Kris, and thanks to JP Morgan.
Thank you for having us. This was really fun. My favorite thing.
That was great. Enjoy the rest of your day. Thank you, everybody.